Disney is down almost 60% from its all-time highs, which is leaving many investors asking if the stock is looking cheap today and if this is an opportunity to buy it. However, Disney is currently undergoing some massive changes to its business and its fundamentals. So in today's video, we are going to dive into Disney's stock and I'll share all of my research with you and my opinions on the stock today. So with that being said, let's now dive into the video and let's start off by taking a look at Disney's most recent quarterly update. And this says that revenues for the quarter and the 9 months grew 4% and 8% respectively. So Disney's revenue is continuing to grow. However, the diluted earnings per share for the quarter was about $1.03, which was down from $1.09 last year. So the revenue is growing, but the profitability for the business looks like it is still going down. Then the CEO says here, our results this quarter are reflective of what we've accomplished through the unprecedented transformation we're undertaking at Disney to restructure the company, improve efficiencies, and restore creativity to the center of our business. So Disney is currently undergoing a restructuring and the CEO is trying to regain the company's historical profitability. Then they say that the company improved its direct-to-consumer operating income by roughly $1 billion in just 3 quarters. While there is still more work to do, I'm incredibly confident in Disney's long-term trajectory. So they are making improvements to the overall business's profitability, and especially their direct-to-consumer business, which is basically the Disney Plus segment of the business. Now, this next screenshot is kind of like the income statement and profitability metrics for Disney as of the last quarter. And year over year for the third quarter, their fiscal third quarter, we can see that the revenue was up 4%, and year to date, the revenue was up 8%. However, we can see that the total segment operating income is essentially flat for the quarter, and for the year to date, the operating income is actually down about 6%. So again, revenue is growing, but profitability looks like it is still taking a hit at least year over year. However, we can see that the cash flow metrics are improving, and the cash provided by operating activities was up 46% year over year, both for the quarter and year to date. And then the free cash flow was about 1.6 billion, which is up greater than 100%. And last year, year to date, they had a negative free cash flow figure. So the free cash flow is seeing a lot of growth this year. In my opinion, it is great to see Disney improving its cash flow metrics and generating free cash flow once again. Now, moving on to the next screenshot, this covers Disney's different segments of the business and its revenue and operating income that the different segments produce. So we can see here that the Disney Media and Entertainment Distribution actually saw its revenue decline by about 1% year over year for the third quarter. And in the 9 months ended July 1st, the revenue is up by about 1%. So Disney Media and Entertainment Distribution are basically not really growing year over year as a whole segment of the business. So where Disney's growth is coming from right now is from its Disney parks, experiences, and products, which did see about 13% year over year revenue growth. This is the same thing for the operating income of the business as well. Disney's Media, Entertainment, and Distribution segment saw its operating income decline by 18% year over year, but its Disney Parks, Experiences, and Products saw its operating income grow by 11%. So the Disney Media segment of the business is seeing its revenue and operating income continuing to decline, while the Disney Parks is seeing its revenue and operating income continuing to grow, and that is where Disney's growth is actually coming from right now. So then Disney breaks this down even further, and they show us their direct-to-consumer revenue, which is quite literally Disney Plus. And we can see that Disney Plus did grow by 9% year over year for the third quarter, and it is up 12% year over year for the 9 months ended July 1st. However, we can see that the content sales and licensing is down, and the linear networks is also down. And this overall business segment includes these 3 revenue sources right here. So when you combine all of these, the revenue was down 1% year over year. However, we can see that Disney Plus's operating income loss did decline to about 512 million from about a $1 billion loss last year. So the operating income that Disney Plus is producing, or the losses that it is producing, is starting to go down and it is getting closer to profitability, which is what the CEO said in the update there. Now, if we move on to Disney Plus subscribers, we can see that it did grow by about 1% quarter over quarter to about 105.7 million subscribers around the world. ESPN Plus is not really growing, and then total Hulu is also not growing. So overall, it looks like Disney Plus and their overall subscription businesses are not really growing. Disney Plus is the only one that grew here by about 1% quarter over quarter. So, which in my opinion is really not that amazing, because it ultimately means that for Disney Plus to continue growing its revenues or its operating income, they have to continue increasing the prices to continue fueling growth, And then to increase its profitability, they have to continue cutting costs out. So that is really how Disney Plus is going to grow going forward, is either through price increases or cutting costs, or a mixture of the both, which does kind of seem like that is the business's plan. Now, this next screenshot shows us where the growth to Disney's parks business is coming from. And it is coming from the international segment, which did produce about $1.5 billion in revenue, which was up 94% year over year. And this is where the most revenue growth for the business came from. We can also see that the operating income for international did grow by about $500 million year over year. So that is where the growth to Disney's operating income really came from, was from the international parks segment of the business. I then went and found the explanation for why this segment of the business was growing so much, and this is what Disney had to say. Higher operational results at our international parks and resorts were due to growth at Shanghai Disney Resort. The increase at Shanghai Disney Resort was due to the park being open for all of the current quarter compared to only 3 days in the prior year quarter. So it looks like Disney's international parks are starting to open up, especially over in China and over in Shanghai. And this is why the business saw so much growth to revenue and operating income year over year, especially for its parks segment of the business. Now, moving on to the next screenshot, this kind of shows us the different cash flow metrics and capital expenditures for Disney's different business segments. We can see that the Disney Media and Entertainment Distribution segment saw its capital expenditures grow to $755 million from $543 million last year. So Disney is spending more money on its Disney Media segment of the business, and its capital expenditures there are continuing to grow. However, the company's overall capital expenditures did decline to about $3.6 billion on the quarter, which is down from about $3.8 billion last year. And where the decline came from was the lower capital expenditures in Disney's domestic parks business. And then they explain further down here. Capital expenditures decreased from $3.8 billion to $3.6 billion, primarily due to lower spending at Disney parks, experiences, and products, partially offset by higher spending at Disney Media and Entertainment Distribution and Corporate. Higher spending at Disney Media and Entertainment Distribution was driven by higher technology spending to support our streaming services. So Disney is having to spend more money on capital expenditures associated with Disney Plus and its streaming businesses, even though these businesses are not really growing that much anymore, and they are still losing money. Now, to top this all off, on August 9th, 2023, Disney did announce that it is planning to increase its prices on its ad-free Disney Plus to $13.99 per month, starting on October 12th, which is in about a month from now. And this is exactly what I mean. For Disney to continue growing its revenue on Disney Plus and its profitability on Disney Plus, it is now going to have to continue increasing its prices because its subscribers are not really growing that much anymore. Now, the problem here is that there is going to be a point somewhere along the line where Disney cannot raise its Disney Plus prices anymore before subscribers start to leave the platform. And personally, I've already canceled my Disney Plus subscription because I just wasn't really using it anymore, and I didn't really see that I was getting much value from it. The only streaming services that I have now are Netflix and Amazon Prime, and I have Amazon Prime streaming. I have it for the delivery aspect of Amazon. So the only real streaming service that I am actually paying for now is Netflix. I cut out basically all of the other ones, including Disney Plus. Personally, I think that there will come a point where Disney is not going to be able to increase its prices anymore, because there is going to become a point where people simply stop subscribing because the prices are getting too high. So here's my take on Disney Plus and the overall business of Disney today. And to start off, we actually have to go back in time to November 8th, when Disney announced that it was going to start investing in Disney Plus, and it was going to roll out Disney Plus over the next year. Then about 1 year later, on November 12th, 2019, Disney Plus was officially launched. The stock price ran massively on these announcements, and in 2019, the stock was up over 30% alone. Disney's stock finished 2019 at a record high price to sales ratio, which means that the market was valuing Disney's revenue much higher now that it was also a streaming company. The stock price and the price ratios expanded to all-time highs, and investors were very bullish and excited on the company. The revenue was also growing throughout 2020 as Disney Plus was growing, and even today, Disney is hitting all-time high revenues. However, when Disney announced Disney Plus, its operating income started collapsing rapidly. It continued falling dramatically in 2020 because its parks were also closing around the world. But even before the world shut down, Disney's profitability was already tanking, and it's still way down from its all-time highs. Its operating cash flow is well below its historical highs too, and this is the same story for the company's free cash flow. What's happened is Disney Plus has totally changed the profitability of this business. If we head over to Stock Unlock, we can see that Disney's free cash flow margin peaked at about 19% in the first quarter of 2018. And we can now see that Disney's free cash flow margin is about 3%. Now, if we go and take a look at the free cash flow just on a total basis, we can see that it is about 2.85 billion now in the trailing 12 months. And the last time Disney produced this level of free cash flow was back in 2009. So its free cash flow levels are all the way back to what it was producing back in 2009. However, the company's free cash flow is accelerating and growing right now, but it is still well below what it was generating back in 2018 before the company started investing so much money in Disney Plus. And back in 2018, the company was consistently generating free cash flow of about $10 billion on an annual basis. So the free cash flow levels are still down about $7 billion from their all-time highs. Now, what we can also do is take a look at Disney's price to free cash flow before it started investing so much in Disney Plus. And right here, we can see that the average from 2008 to 2018 before Disney Plus was about 19.3. So this is what the company was historically selling for before it became a streaming business as well. So now we can pull out our calculator to see the amount of free cash flow that Disney would have to produce on its market cap today to get back to a price to free cash flow of about 19, which was its historical average before it became a streaming business. So the company is worth about $153 billion on the stock market today. So we can divide this by about 19.3, which tells us that the company would have to generate about $7.92 billion in free cash flow to get back to its historical price to free cash flows on the market cap today. Again, the company is producing about $3 billion in annual free cash flow today, which means that it would still have to more than double its free cash flows that it is currently producing to kind of justify the market cap or the valuation of the business today, or just to get it back to its historical averages. That is still a tall order for me personally, because I am not bullish in Disney Plus at all. To put it simply, Disney Plus has completely changed the business, and in my opinion, it has created no shareholder value. Disney's overall fundamentals actually look much worse with Disney Plus than without it, and I think that the share price tanking and being down so much is actually justified. I'm personally just not bullish that Disney will ever regain its historical profitability while it's pouring so much money into Disney Plus and losing so much money on Disney Plus. Streaming is a very low margin business even if it is done well, and Disney hasn't been able to turn a profit on it. As I said, I also canceled my own Disney Plus subscription because I don't see enough value in it, and the only one I have left now is Netflix. So yes, Disney's overall revenue is higher, but the quality of that revenue is much lower, as the business is not able to return as much profits back to its shareholders. And I am just not confident that they will be able to fix this without completely stopping Disney Plus and getting rid of that business segment altogether. I do think Disney is a better business without Disney Plus, and so far, Disney Plus has created no value for shareholders, and in my opinion, has been a total waste of money. So that is my opinion on Disney, and I know that the stock is down 60% from its all-time highs, but I just don't think that the fundamentals of this business look that attractive. I think that the company is undergoing a turnaround right now, and it is restructuring the business, but I think it still has a long way to go before I would even consider this business fair value. Because even with that little rapid acceleration to free cash flow, it still is selling for a price to free cash flow of 54 today, with a free cash flow yield of only 2%. So even if the business does manage to double its free cash flow, it would still be selling for a free cash flow yield of under 4%. And when bond yields are offering above 4%, I just don't really see the reason for me to take on risk buying Disney stock. Because again, even if they do double their free cash flow, I could still be getting a higher yield on a bond today. So Disney would have to see a massive turnaround, a massive boost to profitability to get to above what bonds are yielding today and actually sell for a margin of safety. So currently, I still think that there is a lot of risk with the stock. And with Disney Plus and how much money it is still losing, I am just not confident that Disney is ever going to get back to its historical high profitability. I would want the company to cut out Disney Plus altogether before I start investing in this business, or see some sort of massive miracle where Disney Plus suddenly starts producing billions of dollars in free cash flow for its shareholders. Outside of that scenario, I'm not really interested in Disney stock at all personally. So all of that is my opinion on Disney. And if you enjoyed this video or found it helpful in some way, then please remember to leave a like on it because it really does help out my channel and I really appreciate it. Also, the stock analysis platform that I use here on my channel is Stock Unlock. I use this platform for absolutely everything from analyzing businesses, comparing businesses against one another, and even tracking my own portfolio. And if you want to check out Stock Unlock, then there will be a link in the description where you can go and get a 14-day free trial with no credit card needed. It's a great platform, and yeah, I'd really appreciate you guys going and checking out Stock Unlock. Also, if you're new here and you want to stick around and see more stock market related content like this, then please consider subscribing to my channel as well, because that would be pretty cool. But that's going to be all for me today, everyone. Thank you so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next video.